Global oil prices are on the rise, and the Philippines may soon feel the impact. Economists warn that escalating tensions in the Middle East could drive up inflation and strain the country's economy. Jin Kim has the details.
The Philippines is facing growing inflation risks as global oil prices continue to surge amid heightened tensions between Israel and Iran. Economists warn that the escalating conflict could drive up the cost of goods and further strain the economy.
For every $10, kumusta yung magiging pag-pick up ng inflation? Siguro mga 0.2 to 0.3 percentage points. Pero ano yan, kung halimbawa mag-sustain siya on a, yung parang on a monthly basis, no, for a given month, number of months, yung 1.9 na year-to-date average, mag-pick up yan ng mga 2.1, 2.2. Ayun yung impact niya.
For June, I was actually looking at 1.2%, but most likely I'd probably look at it flat at 1.3%. But between now and year end, if this conflict continues over 3 months, then we will probably be heading towards that, again, within the 2 to 4%. So most likely closer to 2.5%. Will probably be our year end.
The heightened tensions have raised fears of a possible closure of the Strait of Hormuz, a vital channel that handles 20% of the world's oil supply.
So if they close that, there will be a shortage and therefore prices will go up. So we will get hit by a double whammy of higher coal prices, and of course that will mean higher, higher coal and fuel prices. So it's a little scary. It will be hard for us countries that are very oil and coal dependent.
Oil prices have climbed to nearly $72 per barrel from around $63 to $64 before the crisis. Experts caution that if the conflict persists and supply is disrupted, prices could soon exceed $80 per barrel, a level that would place a heavier burden on oil-dependent countries like the Philippines.
We're really vulnerable because we import most of our oil coming from the Middle East. So if the Straits of Hormuz there will be some disruptions, then definitely there could be delays in the supply. So it could affect not just the Philippines, but the rest of Asia, no? And the rest of the world. So we're really vulnerable.
The peso is already feeling the pressure, now at 56.60 against the dollar, down from 55 last month.
Since April 30 nga, the peso has depreciated by 1 peso na, di ba? 56 something, 60 na yata tayo, so over 1 peso.
Alongside rising import costs, analysts are watching for possible capital outflows as investors shift to safe havens like the dollar and gold.
People run to safety, and for local investors and even among our ASEAN neighbors, the tendency is to buy the dollar. And especially for net importing countries like the Philippines, the US dollar is the best currency to eventually lean on. Although, of course, other investors who are more sophisticated will try to look at the likes of gold because they feel that if this is still inflationary, then people will eventually go to gold.
There might even be a capital flight. They'll put their money, again, not necessarily in the US, but other stable currencies also, stronger economies. So that will mean that even risk assets might also move from equities back to the safer fixed income and even gold and other commodities, right? Because those prices would go up. So we've seen gold prices go up. I wouldn't be surprised if it goes up even further.
The PSE index is currently trading at low 6,000 levels. Francisco is hopeful the market won't slide further unless the situation worsens. He adds that if the conflict de-escalates and trade barriers are addressed, the index could climb by as much as 8%, reaching 7,000 within 8 months. Jin Kim, Billionaire News Channel.